So, if you want to fight against inflation and even see an appreciation on your assets, the smartest way is not to keep working and working by your labor force, but to adopt the system and understand the financial rules. Don't work for money, let money work for you. Hi everyone! Finally, it comes to the third chapter of asset optimization. The last two episodes revealed how Hong Kong people were good at optimizing assets in the last few decades. We also talked about the secret of getting rich by speculating on properties with low cost and high leverage. As mentioned previously, that in recent years, the market is flooded with many unprofessional people, it made the concept of optimizing assets sound overflowing and empty. This episode will explain it with a few more examples and specific scenario. We will also talk about the tools that professional investors often use but is still not widely known. First, let's revisit the concept of arbitrage. In fact, it is nothing more than 3 steps. First, put the asset to remortgage for a low-cost loan. Second, buy in high-yield assets with the remortgaged money. Third, simply add leverage. It's easy, isn't it? If you have trouble understanding what I'm talking about, you may want to watch the last 2 episodes. In fact, each step has different points. First of all, do you know the LTV of same assets? How could I have gotten money at the lowest cost? What product should I choose for carry trade? Finally, it is important to adjust the leverage ratio and cash flow control. Step 1. Use assets for a loan at low cost. First, please look at all the assets in your hand. Then, select the assets that the banks will offer the lowest possible interest rate. For most of the time, everyone feels that the interest rate from the property mortgage is the lowest one and the terms are the best. But do you know that the original LTV of bank collateral securities can reach 60% or more, and the interest cost is only P3%. The terms are even better than the property mortgage. Traditionally, private banks can even use insurance policies for collateralized financing. The cost is as low as 1%, with 95% or even 100% of the cash value can be loaned out. Nowadays, it is also popular for retail banks. The second step is to buy assets with passive income. Generally speaking, the target asset return must be higher than the risk-free interest rate, about 0.6%, so it is worth investing. However, if you fail to catch up with inflation, which is a 10-year average of 3% approximately, the value of money is actually lost. The information about US Treasury bonds and inflation can be reviewed. Benchmarks in the market are even harder to reach. A research shows that nearly 90% of the fund's performance is worse than the market benchmark, which our annual returns can reach 8 to 10%. How can you be sure that your investment will be higher than inflation or even higher than the market benchmark? The third step, leverage. Some people may believe that leverage as an investment means putting an extra increase in risk. But in fact, professional investors don't use their money to invest or do business. Or in other words, they always know how they could use others' money to make the most out of it for their gains. The key to leverage is to use the lowest possible cost and have control over most possible capital for arbitrage. For the smart of you could tell by now that leverage can be used for a property mortgage. Using the purchase of property as an example, 50% of the value of mortgage properties can be loaned out as a mortgage. You can only use 5 million Hong Kong dollars as the first installment payment for a 10 million asset, which is twice the leverage. There is loan offer with 10 times leverage. Real estate developers can borrow more than 100% of the property value. The product and the banking terms are changing all everyone know it in time? So the point of these 3 steps is to understand the benefits, leverage, and terms of different assets. Also consider the risk balance. If you have no idea about expected return, you can watch our knapsack stock thief videos. For example, if someone has $1 million Hong Kong dollars in the bank fixed deposit account, what do most people do about it for optimization? Carry $1 million for a year with an annual interest rate of 2%, so the annual interest will provide the interest income of $20,000. What do other players do? The same $1 million will be paid at 2% interest, but it turns out that the banks can lend 90% of the value at 1% interest cost, which is $900,000. And that $900,000 can do another deposit at 2% again and again. Those who understand the geometric sequence can quickly calculate the principal of $1 million. It becomes a fixed deposit of $10 million, in other words, 10 times leverage and 10 times spread. The interest cost is 1% times 9 million, which is equal to 90,000. Interest income 2% times 10 million, which is equal to 200,000. Actual income 200,000 minus 90,000, which is equal to 110,000. That is a net profit of 11% a year. Professional players make 11% of net profit easily. The capitalist financial system is so perfect that the poor get poorer and the rich get richer. Therefore, Hong Kong's Gini coefficient has been ranked number 1 in the world, and it's only getting worse and worse. At last, cash flow forecast is also important. As the example above, there is an interest expense of 90,000 that needs to be paid out on a monthly basis for the interest gain of 200,000. You might ask, what if I could not even afford the interest payment of 90,000? I know you might have it, but you do not want to pay for it. In fact, the answer is very simple, and if you want to maintain it by balancing the profits and the cash flow, you could also make a good use of the principal of $1 million, in which 970,000 will be used for interest gain, while 83,000 will be reserved for the monthly interest payment. 90,000 times 91.7% is equal to $82,530. $83,000 is more than enough for the deduction. $100,870 is the net profit for 1 year, which is a return of 10%. In fact, it would be sacrificing about 1% of the profit in order to cover the interest expense, so there is a controllable trade-off in the general income and cash flow. And the profit sacrifice is also used as a hedge tool against the liquidity risk. Another smarter way to deal with it is to use fixed income tools such as bonds or mortgage link account that most people have, and to optimize the returns of the entire portfolio. In terms of optimization of property assets, I will disclose 4 major entry methods based on a few real case studies in the past. Let's take a closer look and see how it could improve the quality of life rather than just being rich on paper. The first idea is 50% off on mortgage repayment. Mr. Huang, who is 30 years old, property in Sha Tin district purchased in 2012. The mortgage repayment is basically $14,775 per month. The repayment duration is 20 years, and the outstanding mortgage is $2.39 million left. The interest rate is 2.85%, which is equal to 2.15%. The property price has gone up from 4.8 million to 7.2 million in 2018. The remaining mortgage amount equals to $14,775 times 12 times 16, which is equal to $2,836,800. $1.93 million is remortgaged from the property for refinancing. The portfolio could make interest gain, and the interest accumulated would be enough to pay off the mortgage in 2027. As a result, the mortgage duration has been shortened to 10 years. $14,205 times 12 times 8 equals to $1,363,680. The total contributions of the new plan, or original total contributions, are $1,363,680 divided by $2,836,800, which is equal to 48%. After the mortgage repayment is done, most of the property owners would reach the age of 60, 70, or even 80 years old. In some cases, this burden would be left to their kids. The pressure on the young generation has been increasing nowadays. They may also be worried about losing their jobs, so the repayment would be unaffordable. This method can greatly optimize the value of the property through the smart use of resources and make their life easier. The second benefit is free upgrade on property. Mr. Chen, who was 42 years old, in 2008 he bought a 500 square foot unit in Chunwan district worth of 2.5 million. The down payment is 750,000 and the monthly payment is $9,048 for 20 years. The interest rate is P minus 3.1%, which is equal to 2.15%. In 2016, the old property was sold for 4.5 million. After deducting the remaining mortgage of 1.13 million, the cash from selling the property was 3.37 million. At the same time, he bought a 600 square foot unit worth of 5.3 million in the same district, with a down payment of 2.12 million. The remaining cash, 1.25 million, is used for arbitrage. So the result, the original mortgage can be repaid after 12 years, that is in 2028. The total payment is $9,048 times 12 times 12, which is $1,302,912. The new asset portfolio makes interest gain, and it would be enough to pay off the mortgage in 2028. The total payment is $9,045 times 12 times 12, which is equal to $1,302,480. The total contributions are the same. When a 2-person family has become a 4-person family or even a 6-person family, the living space would be insufficient. A good use of the resources in hand could actually make the property larger. The third benefit is double the rent income. Ms. Liang, who is 52 years old, full paid property in Hong Kong Island. In 2016, the valuation was about 9.6 million and the monthly rent was $25,000. 5 million was refinanced for the plan. 10 years of interest gain through arbitrage result in a profit of $3,049,536. The monthly income in average is 3.05 million divided by 120, which is $25,413. The property owners who bought the building in the past 20 years and their assets have doubled or even tripled in value, but it was just rich on paper. I bought 10 lot of HSBC stock in the hope of receiving stable passive income in the old days, and it turned out, FML. Moreover, you did not really earn a so-called profit until you realize it. Why don't you earn some money while enjoying life in your idle asset? The fourth benefit is asset inheritance. Mr. Leung, who is 60 years old, has a property full paid in Hong Kong Island, which was bought 30 years ago. The property had appreciated from $300,000 to $7,500,000. He has 3 sons. If they inherit his assets, each of them deserve 1 out of 3 of the ownership value. Mr. Liang can cash out $3,750,000 and insure the lifespan of 22 million people. If the father passed away at the age of 90, the interest expense is 30 years would be about 2.1 million, which means that the average son would spend 700,000, and inheritance equals to property plus 22 million, and each son should also account for 1 out of 3 of the ownership value, plus an additional gain of approximately 7 million per person. This method can make all 3 children remember their father in the whole life, with good intentions, and they only need to understand different tools and methods. Greatly avoid the conflicts and discord between the left 3 children or the brothers due to uneven distribution of wealth. Of course, however, each person's assets, income, risk tolerance, objectives, and family status are different. Please contact us if you need tailor-made suggestions. Thank you for watching. Please like, share, subscribe, and comment below. Thank you.